Buying a home in 2026 is going to be the same, but much different when it comes to how and when you actually save money on your closing costs and even your mortgage insurance if you're putting less than 20% down. So if you're a first-time homebuyer, I'll tell you about my favorite first-time homebuyer program for 2026 and show you how it's easier than you think to save a minimum of $10,000 when you buy a home. But remember, these two things I just mentioned, it's all about how and when in 2026 when it comes to savings. And I'm gonna start with my favorite first-time homebuyer program, and whether you're a first-time homebuyer or not, you can use money-saving strategies and we'll review those together. So let's get into what my favorite program of 2026 is gonna be. So actually, before I get into that, I'll get to it just a little bit. Why don't I show you how to save some money? Because regardless of what program you're gonna use, whether it's my favorite or not, you wanna know how to save money. So I'm gonna give you two ways that you can save money after I get whatever's in my eye out of it. Oh man, whoo, that eyelash. So here we go. First money saving program is gonna be a temporary rate buy down. Now, there's a lot of talk about temporary rate buy downs, probably for the last 2 years now, right? This is a way to reduce your interest rate temporarily while we wait to see rates potentially come down even lower. And it just helps you ease your way into home ownership with a much lower monthly payment. Temporary rate buy down, the name kind of says it all, right? It's not permanent, it's for a set period of time. And here are the typical timeframes for temporary rate buy downs. You have a 3-2-1, you have a 2-1, you have a 1-1, and you have a 1-0. And I'm gonna explain what each of these are. A 3-2-1 temporary rate buy down means that your rate is 3% lower in year one, 2% lower year two, 1% lower year three. That's a 3-2-1 buy down. A 2-1 buy down, your rate is 2% lower year one, 1% lower year two. 1-1 rate is 1% lower, wait for it, year one and year two. And a 1-0 buy down, rate is lower in year one. But what happens after the bought down period? Well, your rate would just go to whatever your interest rate would have been had you not received a temporary rate buy down. So for example, if the rate was 6.5% that you qualify for, this is what the rate would go to after the bought down period, right? Because it's a temporary rate buy down. So that would mean in year 4, it would go to 6.5. In year 3, it would go to 6.5. In year 2, it would go to 6.5 with each of these examples. So that's a temporary rate buy down. Now, this is a great way to reduce your payment substantially in the short run, right? Anywhere from 1 to 3 years because it's temporary, but it moves the payment a lot because think about it, your rate's dropping by a full 3% in this example, a full 2%, a full 1%. So that makes a big difference in your monthly payment. But the cost to do a temporary rate buy down like this is pretty high. And it only makes financial sense when the seller of the home you're purchasing is the one covering the cost, because every dollar of cost associated with the temporary rate buy down is the same dollar you're going to save with the temporary rate buy down. So if you save $1 per month, it was going to cost you $1 per month. So for you to pay for it doesn't make financial sense because it's the same dollar. But the seller of the property, if they're willing and able to give a credit, and I'll talk about that strategy in just a little bit, they can actually use that, or you can choose to use that for a temporary rate buy down. So this is the first way to save in 2026. It's a great way. But what I'm thinking is going to become even more popular than this in 2026, just another way to save money on a monthly basis, which we haven't seen for a little bit, is a permanent rate buy down. So we talked about temporary rate buy down. That was for a set period of time. A permanent rate buy down means it's for the life of the loan. So let's just say once again, you qualify for a 6.5% interest rate. The seller or yourself technically can pay for this. You decide you want a reduced interest rate because who doesn't want a lower interest rate? We all do. And maybe your goal is to have an interest rate of 5.999%. You want to have that 5 in front of the decimal point, and you're currently at 6.5%. Well, to drop your interest rate from 6.5% to 5.99%, it may cost 2 points. Now, some of you may have heard the word points before when it comes to getting a mortgage, and you might have your parents, grandparents, aunts, uncles, everyone who's not in the mortgage industry is probably telling you don't pay points. However, there are times it does make financial sense to pay points, and that's all about the length of time you plan to keep the property, which I can talk about as well. But 2 points equals 2% of your loan amount. I've had people ask me, realtors included, how much are points these days? They're always the same. 2% would be 2 points. That means 1% is 1 point. 1 point is always equal to 1% of your loan amount. Obviously, the dollar amount can change because your loan amount could be different from one person to the next, or is going to be different from one person to the next. But no matter what, 1 point is always 1% of the loan amount. So in your case, let's just say it's going to cost you 2% or 2 points to get the rate down by 0.5%. 5%, right? That's about 0.5% between a 6.5 and a 5.99. We'd figure out what you're borrowing. If you're borrowing $400,000, right? It's your loan amount. 2 points would be $8,000. We'd have to do the math, figure out what you're going to save on a monthly basis, compare that to the cost, figure out what your break-even point would be, and that's how we can determine if it makes financial sense. Now, once again, you can get the seller of the property to cover this, and I'll show you what that strategy looks like just a little bit later in this video. But this is a great option instead of the temporary rate buy down, because your rate and your payment, right? Therefore, your rate, payment go together. Your payment's going to stay permanently lower. It's not going to go up after year 1 or after year 2, after year 3. Now, you're not going to see as substantial of a savings in the short run. However, you don't have to think about the rate ever increasing. There's more stability with a permanent rate buy down. So I think we're going to see a lot of this in 2026. I think it's going to become more popular than the temporary rate buy downs, because a lot of people decided they wanted to date the rate and buy the house, was a term that was going around a lot, where, hey, let's buy the house. We can always refinance, get the lower rate. The problem is that rates haven't come down quite as much as people were hoping over the last 3 to 1 year. And so rates are a little lower now. So just take advantage of that and buy it down permanently from there. And then you don't have to worry about having to refinance in the future, because there will be a cost associated. If rates drop far enough where it makes financial sense for you to refinance, then at that point you can go ahead and do it. But I think that the permanent rate buy down is a great way to keep your payment reduced for the long run. So now you know how you're going to save money in 2026, but when do you save this money? Well, I keep mentioning that you can get the seller of the property to potentially cover these costs, and that's by way of what's called a seller concession. A seller concession, also known as a seller credit, can be used to cover that. It can be used to cover many things. I mentioned earlier, if you're putting less than 20% down, there's a way to have the seller cover the cost of your mortgage insurance so that you're not having to pay it on a monthly basis. But this is something you need to do when you're negotiating the contract on the property. Something that you don't hear about often, and something that I pride myself on with my team, is that we put together a strategy with our clients of how to submit offers on properties. And the strategy requires 3 people to be involved. You as the borrower and buyer, us as a lender, and your realtor who's helping you find the property. Because all 3 of us need to work cohesively to be able to put together the best possible terms for you on that property. And part of it is having a strategy session where we talk about exactly how to approach the offer. It might not make sense to try to offer less than what the asking price for the property is. In most cases, it actually makes more sense to go in at the full asking price and request a credit to help cover things like these buy downs, or in some cases, even buying out the mortgage insurance altogether, because that's where you're going to see your immediate savings. Now, over the long run, paying the full price for the home will cost more. However, there are very few people, and I've yet to meet someone, that's planning to keep their home for the full length of a mortgage, right? 30 years is the most common type of mortgage, or the most common mortgage length that we see. The goal should be to reduce your out-of-pocket costs for the period of time you plan to keep the home. So the strategy that you want to use is asking for a seller credit. Now, I believe that this will still be something that's possible, at least for the first quarter of 2026, because I just believe that after the first quarter of the year is when we're going to see an influx of buyers to the market, because that's when I feel we're going to see interest rates come down further, and that's what's going to drive those buyers in. When there's more buyers in the market, you have more competition for the properties that are available in the market, and when there's more competition for the properties, that drives prices up. Right? Supply and demand. The demand increases, the supply stays the same, then it increases the price on the properties that are available to you. So I think you're going to see less sellers who are willing to give credits when they have more buyers fighting for the same property. But at least in the first quarter of 2026, I feel like this is still going to be something that's possible with most offers. But you make sure that you built this into your offer that you're making on the property before submitting it, not after submitting the offer. It's really hard to go and unwind terms and ask for money after the seller's already agreed to specific terms on the property, meaning the purchase price for that property. So depending on the type of mortgage you're getting, it's going to determine the amount of the credit you can receive. So I'm going to keep it simple. Treat it as if you're buying the property as a property you're actually going to live in. So let's just say you're getting an FHA mortgage, for instance. You're allowed to get up to a 6% seller credit, meaning the purchase price times 6%. If it's a conventional loan, your down payment is going to be a dictator of how much you can actually get from the seller. So let's say you're like the average buyer and you're putting anywhere from 3% to just a little less than 10% down. You're going to be capped at 3% in seller credit. If you're doing 10% plus, that goes to 6%. If you go to 25% plus, this is gonna go to 9%. Most people fall into this category. If you need the seller credits in order to even purchase the property, because maybe you've saved up just enough money for a down payment, but you don't have quite enough money to cover your closing costs. Well, you're gonna wanna lean toward an FHA loan just because you have more flexibility on the amount of the credit you can receive from the seller. Plus, it can help be used for the strategies I mentioned earlier, which is gonna be a temporary rate buy down or a permanent rate buy down. As a matter of fact, you can combine the two, which is gonna push your rate down even further. So that's, for one, when you wanna ask for those credits. It's extremely important because, like I said, if you don't ask for them in advance, meaning at the time you're submitting the offer and just building it into the offer itself, it's really difficult to try to unwind that and change the terms that everyone's agreed to. And now, the moment you've all been waiting for, my favorite program of 2026. And actually, it's been my favorite program for a while. I love FHA mortgages for the purchase of multifamily properties. And here's what I mean by that. So we're gonna talk about an FHA mortgage for the purchase of a duplex in this example. What's a duplex? For those of you that don't know, it's a 2-unit property, meaning it's like a freestanding townhome or a freestanding home, but it's two connected to each other and you own both as one property. What do you do with those? Well, you live in one side and you rent out the other side. But here's the nice thing about that. Everyone talks about home affordability, how it's tough to afford a home right now. This is a great hack to make housing more affordable. Here's how it works. Let's just say you're gonna buy a $600,000 duplex. Sounds like a high number, but don't worry, I'm going somewhere with this. Your down payment on this would be 3.5%. So what does that work out to? About 21,000. Let me do a quick math. So your down payment is $21,000, 3.5%. This is what you're responsible for this transaction, $21,000. Just keep that number in mind. Now, what do you think a monthly payment is for a $600,000 property? Well, let's figure this part out. We'll start with taxes. Figure that taxes, I'm here in Florida, figure taxes on a $600,000 property are somewhere around $1,000 a month. Insurance on a $600,000 property, I'm gonna call that $500 a month. We're gonna have to pay mortgage insurance because we're putting down less than 20%. Plus it's an FHA loan, you have to get mortgage insurance and pay that regardless of your down payment. And then on top of that, we're gonna have principal and interest. So we're gonna figure out the mortgage insurance, then we're gonna figure out the principal and interest portion of the payment. So mortgage insurance, on FHA loans, mortgage insurance, when you're putting 3.5% down, is 0.55% of the loan amount. This is what the cost of mortgage insurance is, monthly mortgage insurance. So I'm gonna do that math. So we do 600,000 minus 21,000 is 579,000 is our loan amount, which means our mortgage insurance is gonna be $265.38 per month. Now we have to figure out the actual mortgage payment, which is made up of two pieces, principal and interest. Now, so this is important. On an FHA loan, you have to pay something called upfront mortgage insurance premiums, UFMIP. This is 1.75% of the loan amount. So we already said our loan amount's $579,000. 1.75% of that is $10,132. So what we need to do is we take this $10,132, we add it on top of the $579, which is the base loan amount, 96.5% of the purchase price. And that's gonna give us $589,132, pardon the handwriting. This is what our principal and interest payment's gonna be based on. So FHA rates right now are pretty low. They're somewhere in like the mid to high fives. So I'm gonna use a 5.75% for my calculation. So I'm gonna do $589,132. And by the way, I'm using a mortgage calculator on my phone. You can find one online if you want to do your own calculations, or comment below what calculation you're looking for, and my team and I can do that for you. We do over 30 years, 5.75 interest. Our principal and interest is $3,438.01. Now we need to figure out our total payment. To figure out our total payment, we're going to add all of these things together, right? So we have 1,000 for taxes. We have 500, hold on. 1,000 for taxes, 500 for insurance, 265.38 for mortgage insurance, 3438.01 for principal and interest. Our total payment is $5,203.39. This is a high payment for just about anyone, right? That's a big payment. But like I said, the reason this is my favorite program of 2026 and really most years is because, like I said, this is a duplex. There's 2 units. You're only living in one of them. So what's happening with the other one? Well, you're renting it out. And so let's just say a $600,000 property, you might be renting out the second unit for $3,000 a month. So what happens if you're receiving $3,000 a month in rent? Well, you take that $3,000, it gets subtracted off of your total payment, meaning that your net payment after your rent, is $2,203.39, less than half of what you would pay for a $600,000 single unit, right? Single family home. This is the house hack of 2026, my favorite program of 2026. And if you want to buy in 2026, you're starting in the right place. Comment below if you want my team to strategize with you and put you on the path to homeownership this year.